It has been a period of significant progress. We have in place an operating model to suit our business and the right people in key roles across the business. We've delivered on our production and cost commitments to the market and have begun to regain cost competitiveness versus our peers. We're starting to see progress in a number of places which confirm we're on the right track. This is a testament to our focus on execution and the success of our inward investment program. You can see in our grade improvements in particular, cash conversion is much better and so is our cash flow. And importantly, we're seeing strong ESG performance. Safety continues to trend in the right direction. That's down to a clear safety strategy that emphasizes risk awareness and a clear set of controls to manage the most important risks. Our total recordable injuries frequency rate was 1.26 injuries per million hours worked. That's a marked improvement year on year and less than half the ICMM member average. And crucially, we had no fatalities at our managed operations. Let's look at our key milestones. Free cash flow was up fivefold to $657 million. And free cash flow before growth capital, the metric at which dividends are calculated, was close to $1 billion. Mineral reserves increased 3.5 million ounces pre-depletion. That gives us additions of 12.12 million ounces over the last 3 years. We progressed our reinvestment across the portfolio, with Geita again delivering strong upside. Our balance sheet is robust, liquidity is strong at $2.5 billion, even after acquisition and dividends. Turning to Nevada, we have maiden mineral resources at North Bullfrog, Mother Lode, and Sterling, which we acquired this year. Obuasi met production guidance of 250,000 ounces. Phase 3 is on track for year-end completion. We also set a target of 30% reduction in our Scope 1 and Scope 2 GHG emissions by 2030. And we've declared a final dividend of 18 US cents per share, taking the full year payout to 47 cents per share, or around $200 million. On highlights, we've committed to getting the basics right, and that's what you will see here. We've delivered strong year-on-year improvements in production. We estimate inflation running at about 12%, the impact of the high inflation around the world impacting AGA at around 12% this 2022. And we have limited the cash cost increase to half of that. Or in other words, we were able to reduce in real terms our cash cost per ounce in about 6%. That was helped by higher grades, better planning, efficiency gains, and fewer stockpile drawdowns, which helped offset that inflation. Underpinning all of that is our inward investment drive, which is starting to bear fruit, especially at Geita and Iduapriem. All-in sustaining cost was marginally higher, with improved production offsetting higher cash costs. TSF compliance capital remained a factor, accounting for $31 an ounce of our group ASC. Free cash flow was stronger, as mentioned, even after investing capex of $1.1 billion into our assets, investing $517 million in acquisitions, and paying $203 million in dividends. Our balance sheet is solid, with low gearing and very strong liquidity. Obuasi made good progress during the year and achieved its production and cost guidance. Gold production was 250,000 ounces at a cash cost of $914 an ounce, well below our average even before it's fully ramped up. So far this year, we have been achieving more than 4,000 tons per day. Phase 3 will continue as planned through the end of this year, setting up us for the ramp up to 5,000 tons per day and eventually well over 6,000 tons per day. Iduapriem's production was higher as we treated higher grades from Cut 2, driven by our reinvestment in this asset. As a result, cash cost improved by about 10%. Siguiri's production was higher, this despite a 10-day stop in July related to employment-related protests. Cash costs saw the impact of higher fuel costs, stockpile movements, and a much stronger Guinea franc. We're starting to see the benefits of the Full Asset Potential program at Siguiri. We have mobilized a second contractor to deliver higher volumes of higher grade oxide ore from Block 2. And we have renegotiated key contracts of fuel and consumables, which will help control costs. Geita recorded another strong production result, with production exceeding 500,000 ounces for 2022. Higher volumes and grades drove performance in H2. We're reaching the end of the reinvestment program, and Geita is now back to operating above 500,000 tons per annum. Kibali's production in Q4 rebounded relative to Q3 also driven by grades and volume.